So last week I heard about someone in my area that just lost their home to foreclosure. All their years of building equity gone because they and their real estate agent didn't know all the options for saving it. Their agent only knew one option, and that was to list the home for sale. So as it turns out, this option cost them their credit and their home. Now, if you're late on your mortgage payment and foreclosures in the near future, it can be really stressful. How do you save your credit? How do you save your home? Where do you start? Who can help? All of these questions can race through your mind and be really overwhelming. So you have to be careful of who gives you advice, because people will often give you advice that will help them, such as a real estate agent who makes money by selling the home. Now, if you're new to the channel, my name is Christian Duncan, and I've been in the mortgage industry for over 20 years. Now, in this video, I'm going to go over your options and the pros and cons of each option so you can make the best decision for you and your family. Now, be sure to watch the full video so you can know about each option. This isn't going to be a one-sided list, such as what would come from a real estate agent, now no offense to real estate agents, or from a real estate investor, and no offense to real estate investors either. There can be good options for both depending on what is important to you. Now, this is more of a list that includes all the options so that you have more to choose from. You see, when people are faced with this situation, they usually make decisions based on an option or two that are presented to them by one person who has a vested interest in those options, when in reality, there are many more options. They just haven't heard of them yet. Now, some options aren't profitable for someone to put together, so it makes sense that those people won't be knocking on the door to share it, right? So I'm going over this in a couple of different sections. That way you know exactly what each person can offer as far as options go, and if that person calls, you'll be aware of what it is. So anyways, let's get right into it. In the first section, this is going to be from the loan servicer. Now, this is the company that you make your monthly payments to, right? When you write the check, it's the name of the company that's on the check. They are servicing the loan. Now, that doesn't mean that they own the loan. The loan itself could be owned by another company. So these can be two different entities in some cases, and you may not even know who owns it. You'll just know the servicer, right? As you make your payment to the loan servicer, they forward the payment to whomever owns the loan, and then they get paid a percentage for doing that. Much like a property manager taking a portion of rent for properties that they manage. It's important to know these companies do not want to foreclose, right? It's expensive and can take time and resources. They just want to get monthly payments like clockwork. If someone gets behind, they want to get you back to making regular monthly payments. It's in their best interest to do what they can to help keep you in the home if they can come up with a plan that works. Now, if you get behind on your payments, an option available using the loan servicer is called a forbearance, right? Now, when you are behind on your payment, there's usually an amount needed to get caught up. You'll see this on your mortgage statement, but you can also call the loan servicer to find out how much that is. Typically, what happens here is the mortgage company will take the amount that you are behind, and then they'll create a second mortgage with that amount. So this is usually something with zero interest and zero payments, but might have a balloon payment, which means the entire amount will be due at some point in time in one lump sum payment. Sometimes when it's sold, sometimes it could be 5 years. Now, during COVID, we saw many of these forbearances take place due to a program issued by the federal government. The mortgage company will typically only do this if there's reason to believe that you can make the payment going forward. They'll give up interest on a smaller amount in order to continue receiving interest on the larger amount and avoid foreclosure and that expense that's associated with it, right? Now, the second option from the servicer is called a loan modification, okay? Now, to modify the loan means rewriting the terms of the mortgage. So let's say you had a 30-year mortgage at an 8% rate, and after a year or so, you fell behind on the payment. Now, the mortgage company could modify that loan to a 40-year at a 6% rate, dropping the payment hundreds of dollars per month. You would sign a new promissory note with the new terms, and the new payment can exist for 10 years or 40 years depending on the modification, right? Now, sometimes these can be combined with the forbearance, whereas they'll take that past due amount, put it on the back end as a second mortgage, and then the remaining amount is modified to fit within this budget, right? This can be a really good option to save the home, save your credit, while making the payment manageable. There are some third parties out there that can charge a fee to help take care of this, but be careful, right? After the 2008 real estate crash, many of these companies charged people thousands of dollars, and they didn't actually get a loan modification done. They just took the money and ran. There have been some laws passed to prevent this from happening again, but it's probably not a risk I would take unless the company had many good reviews. Then maybe. Now, you can contact your loan servicer though, and they should be able to walk you through the option. Great. Now, the next couple of options are going to deal with the real estate investor. Now, if you're behind on your payments, you may get phone calls and letters in the mail, postcards, all of that from investors. Now, just as any other business, there can be some really great people in this space nice, but there can be some bad apples, so you got to be careful. I'm going to go over the options that you're likely to hear about. And full disclosure, I have done some real estate investing in the past 10 years or so, and I'm part of several real estate investing groups now, which is where I've learned some of these strategies, and there's a few that I've done. So we'll go over those here. The options for this can be very different depending on if you're wanting to keep the house or if you're going to sell it. Option number one is if you're wanting to sell the house, maybe the monthly payment's just too much. And even if you take care of whatever's behind you, you still just can't take care of it, right? So if you're wanting to sell the house, but maybe you couldn't sell the house on the open market, such as the person that I talked about earlier who actually lost their home to foreclosure. Right now, it's a process called sub 2. Now, this works by having a buyer come in and take over the payment. Now, you've probably heard of people taking over payments on a car. This is similar, but it's taking over payments on a mortgage. The buyer pays an entry fee, which typically covers the cost of what you were behind on the payment, plus any other fees associated with the purchase. Now, this could also include any payment that you negotiate for equity that you have in the property. For the buyer, the entry fee is their down payment. The buyer is listed on title as an owner, and they'll typically make payments directly to the mortgage company. Now, there are some pros and cons to this method. Let's start with the positives. Number one is credit. This will stop the foreclosure process because everything will be caught up, and then clean up whatever you're behind, leaving the mortgage to show that it's in good standing, right? Which is great. Okay. Number two is you may be able to sell it for higher than market value, especially if you have a good rate on your mortgage. If current mortgage rates are in the 7s and you have a rate in the 2s, the buyer could see some value there. Okay. Now let's talk about some risks on this one. When you took out the loan, you likely signed a promissory note which contained a due on sale clause. Okay. Now this says that if the property transfers out of your name, the mortgage, well, it's due in full. Now, it's very rare for banks to call the note due, but it is a possibility and something you need to be aware of. Real estate investors have several strategies to get around this if it comes up. Just make sure you know. Second, this will continue to report on your credit. Now, this can be good so long as the payment is made on time each month, but if it goes late, it will report on your credit. Now, most real estate investors will have a clause in the agreement that if they go late on the payment, the property goes back to you. You want to make sure you understand what happens in this case if you choose this option, okay? Now, third, this could affect your ability to buy a home in the future. It's more of a problem in the first 12 months, but chances are if you were just in foreclosure, you're probably not going to qualify for a traditional mortgage in the first 12 months anyway, right? You see, most loan programs have at least a 2-year waiting period before you qualify if the foreclosure process started. Okay, now if you sold the home this way and your payment was on time, you'd still have to wait 12 months in order to exclude this debt from your debt to income ratios. Okay, there are some things you'll need for that, and we're not going to go into this video. Now, if you're wanting to keep the home, there are several options available. Now, I'm going to share a few with you that I've done. So if you're in a similar situation, you can have an idea to start with. Now, keep in mind, there are no rules to this. So when you and the investor start negotiating, you can find something that works for both of you so that both parties, it's a win-win, right? And so I'm going to go over these stories though, so at least to give you an idea. A while ago, I received a call from a woman that was literally days away from losing her home to foreclosure. The auction date had been scheduled. It was coming. Now, the total that she was behind was about $15,000. And this was at a time when home prices weren't $500,000, right? She had about $80,000 in equity since she had lived in the home for many years and she didn't want to lose it. She said she wanted to downsize and get something a little bit more affordable. So here's what we did. Now, I came in as an investor and paid the $15,000 and structured it as a second mortgage on her home with a 6-month balloon. Now remember, a balloon is just a fancy word for the loan being due and payable at a particular time, right? Which in this case, it was 6 months. Now that gave her some time to finish a couple of projects on the home and then get it sold. Now she was able to list the home after a few months and walked away from the closing with a check for over $80,000, no foreclosure, and a clean 6 months of payment history. Okay, so 6 months later, she put some of that money down on a new home and she has lived there ever since, happily ever after. Now, this type of scenario is a win-win for everyone involved. It's similar to the forbearance offer, but rather than the servicer setting up a second mortgage, private investor funds it. Make sure you are super clear about what you agree to when using this method, okay? Now, here's another. A few years ago, I received a call from a couple who, again, were days away from losing their home to a foreclosure sale. The husband got injured and couldn't work for a while. Now, normally when he does work, they can cover the payment. But as far as right now, being out of work many months, set him pretty far behind. So their property had about $150,000 in equity and they were days away from losing it. So talk about some stress. Now, for this scenario, second mortgage wasn't an option because with him not working, they weren't able to make the payment on the first. So we made a plan to pay off the mortgage in full with a private loan and then give 12 months without any payment required. This would give them the time that they need to get back to work and be in a better spot. Now, 12 months later, they were able to refinance the private loan into an FHA loan, and they also lived happily ever after. And it kind of helped that during that time, the market value of that home moved up substantially, right? And so, timing could be a big thing with some of these as well. I share both of these stories because, as you can see, sometimes you have to be creative to figure out a way to make things work. There aren't any guidelines for investors to follow, but this could be a good thing if you come up with a solution where everyone wins. Now, I love stories with happy endings, don't you? Speaking of happy endings, let's move on to the next section, which is government programs. Now, wait, I'm not sure if government programs have happy endings. I mean, they always say they do, so they must, right? Okay, so there are some government programs that can help you if you are facing foreclosure. Now, these are typically accessed by calling the servicer. Now, again, that's the company that you make the payments to, and they can usually point you in the right direction. Now, servicers may not know all the programs that are available. They're likely to know the programs on the federal level, but may not know of any that are available in your local area. A quick Google search may help. Now, you can search your county and state and then add foreclosure assistance programs. For example, a search that I did was Washington County, Utah Foreclosure Assistance. Be sure to look at the websites that are from the county. You'll see many other websites, but most of these take you down a rabbit hole. If you're wanting to spend hours and hours going down that rabbit hole, have at it. But it might not be the best idea if you're limited on time. Most of these programs are similar to the forbearance option, but rather than a servicer holding the mortgage, the government will hold it. Now, VA just rolled out a program that's for veterans and active duty service members. They just rolled out a program for those who are in VA loans. Okay. Now, another government option, which is more to delay foreclosure rather than completely prevent it, is bankruptcy. Now, once bankruptcy is filed, the foreclosure process is paused, and this can give you some time. Now, keep in mind, this does severely damage your credit, and I'd suggest talking to a bankruptcy attorney if you're considering this option. But remember, bankruptcy attorney only gets paid if you move forward, and I've seen cases where people were convinced by the attorney to move forward, even though it might not be in their best interest. This is why I think it's important to know all options available to you so you can make the best decision, right? Now, let's move on to the real estate agent. Many times when people go late, first person they think to call is a real estate agent. And agents can definitely have some good advice, but it's going to depend on their experience. Some who may have been around for a while still may not be aware of some of these options. Very first thing that I would do would be to contact a loan servicer to see if you can make something happen there, because it's likely going to be the best solution. Now, if you're going to contact a real estate agent, it's a good idea to get their thoughts on what it might sell for, but I wouldn't sign any listing agreement just yet. I would then talk to a couple of real estate investors to get their opinions. After reviewing all the options, I would then make the decision on which I thought would be best for me and my family. So I hope you found this video helpful. Please be sure to like and subscribe. See you on the next one.